For most of your professional life, wealth has been defined by a simple binary state. Either you have it or you don't. You look at a balance sheet, you see a number, and you assume that number represents a portable, liquid reality. But we are entering an era where that assumption is no longer just naive, it's dangerous. Welcome to the era of software friction. Imagine you are closing a significant property deal, or perhaps you're looking to move a portion of your portfolio into a more defensive asset class. You initiate the transfer. In the 1990s, this was a matter of a phone call and a handshake. Today, it is a request whispered into a void of microservices and automated gates. You aren't waiting for a person to sign off. You are waiting for a non-sentient, black box algorithm to decide if your life's work matches its current definition of low risk. This is the new liquidity trap. It is not a market crash or a bank run in the traditional sense. It is a silent, automated wall. It is the moment you realize that while you legally own your wealth, you no longer have the unilateral permission to spend it. As an educator bridging the gap between legacy finance and emerging tech, I've seen this friction quietly calcifying our financial systems. Today, we need to have a sober conversation about why the code now decides the when of your financial freedom, and why the greatest risk to your net worth isn't volatility. It's an algorithm that doesn't know you exist. To understand how we got here, we have to look at the slow migration of authority. In the mid-20th century, financial regulation was an artisanal process. It was human-centric. A compliance officer was a person, someone who lived in your city, perhaps someone who understood the context of your business. If a transaction looked odd, they called you. Regulation was reactive and contextual. Then came the digital shift. The post-2001 era ushered in a massive expansion of the Patriot Act and similar global mandates. Suddenly, the sheer volume of global transactions made human oversight impossible. The Know Your Customer or KYC protocols evolved from a folder in a filing cabinet to a digital profile. But the real shift happened in the last decade. The SaaSification of compliance. Banks and fintech platforms stopped building their own oversight. Instead, they plugged in third-party API gatekeepers, like Chainalysis, Sorin, or Actimize. These systems are designed with one primary goal: to minimize the bank's regulatory liability, not to facilitate your liquidity. We moved from human oversight, which was fallible but reasonable, to automated compliance, which is precise but utterly indifferent to your personal urgency. The regulator is no longer a man in a suit. It is a script running on a server in a jurisdiction you'll never visit. Let's look at the core mechanism of this trap: algorithmic permission. In the modern financial stack, every move you make triggers a series of if-then statements. If a transaction exceeds a certain amount, if it originates from an IP address associated with a VPN, or if it interacts with a wallet address that was 3 degrees of separation away from a sanctioned entity 4 years ago, the system triggers a freeze. This is not a bug. It is a feature of the software. From a developer's perspective, a false positive, freezing a legitimate account, is a minor inconvenience. A false negative, letting a bad actor through, is a multi-billion-dollar fine and a PR disaster. Consequently, the algorithms are tuned for extreme sensitivity. We are now living in a world of guilty until the code proves you innocent. These algorithms operate in what we call black boxes. Even the bank employees often cannot tell you exactly why a transaction was flagged. They simply see a red X on their dashboard. You are trapped in a loop where the technology lacks the nuance to understand your intent, and the humans have been stripped of the authority to override the software. You are effectively waiting for a mathematical proof of your own legitimacy. This brings us to the foundations of the black box. Modern scoring algorithms are built on machine learning models that prioritize high-frequency data over long-term stability. They are looking for velocity. How often do you transact? How predictable is your monthly cash flow? How well do you fit into a predefined cluster of similar borrowers? The problem for many high-net-worth men over 40 is that their financial lives are often low-frequency. You might not have a massive monthly salary deposit because your wealth is tied up in long-term investments, trusts, or private companies. You might not use a dozen credit cards to generate a high-usage score. To an algorithm, this silence is indistinguishable from risk. Integrity, the quality of being honest and having strong moral principles, is not a parsable variable. The machine cannot measure the fact that you've never defaulted in 30 years if that history isn't formatted in a way its neural network can ingest. You are being judged by a gatekeeper that is literally incapable of seeing the very thing, your reputation, that you spent your entire life building. If we look at the data, a startling paradox emerges. The speed of our technology has increased exponentially. We can move data across the globe in milliseconds. Yet, the time it takes for a high-value transaction to be cleared and settled for a private individual has, in many cases, actually increased over the last decade. This friction gap, is where your wealth currently lives. It's the space between clicking send and the recipient seeing the balance. As we move further into Part B, we will examine the real-life case studies of where this has gone wrong, from the freezing of legitimate business accounts to the unintended consequences of AI-driven AML systems. It is time to stop looking at your banking app as a window into a vault and start seeing it for what it truly is: a dashboard for a series of permissions that can be revoked at any time. The question isn't just what you own, but who or what is currently holding the key to the gate. To understand the reality of software friction, we must look at the data behind the compliance industrial complex. Over the last decade, the volume of suspicious activity reports, or SARs, has moved from a steady stream to a flood. But here is the nuance. This isn't because of a sudden surge in global criminality. It is because we have outsourced the suspicion phase to non-sentient algorithms. For the investor over 40, the risk is no longer just a market crash. It is a false positive. Consider the case of a mid-sized real estate developer in London who attempted to move legitimate capital for a closing, only to find his accounts frozen for 45 days. No crime was committed, no laws were broken, but his transaction patterns, large, infrequent, and cross-border, tripped a threshold in a black box compliance suite. The software didn't arrest him. It simply introduced enough friction to kill the deal. The human in the loop, that bank manager you used to know by name, has been replaced by a ticket number in a support queue. This is the first lesson of the new liquidity trap. Your assets are only liquid if the algorithm's pattern matching logic says they are. We are entering an era where innocence is not a legal defense against a software timeout. As we look toward the horizon, we see the escalation of this trend. We are moving from post-facto auditing to real-time denial. In the traditional world, if you did something questionable with your money, you might be audited or questioned after the fact. In the world of software friction, the gate is closed before you even attempt to walk through it. We are seeing the birth of programmable money, not just in the context of cryptocurrencies, but in the coming central bank digital currencies, or CBDCs. Imagine an investment environment where your capital has a use-by date, or where it is geographically fenced by code. This is the ultimate escalation of algorithmic control. For a generation raised on the idea that possession is 9/10 of the law, the transition to permission is 10/10 of the liquidity, is a profound psychological and financial shift. The future scenario isn't one of grand confiscation. It's one of micro-permissions. It's the inability to buy a specific asset class because your risk score, calculated by an AI reviewing your digital footprint, doesn't meet the current administrative requirements. The friction isn't a bug. It's the primary feature of the next-generation financial operating system. The societal consequences of this shift are quiet but corrosive. When code decides when you can spend, we lose the benefit of the doubt, the human lubricant that makes commerce possible. Economically, this creates a two-tier system. On one level, you have the algorithmic elite, those whose financial behavior is so predictable and vanilla that the software never flags them. On the other, you have the entrepreneurs, the contrarians, and the sophisticated investors whose complex maneuvers look like anomalies to a rigid AI. This creates a chilling effect on innovation. If you know that a bold, unconventional investment move might lock your primary accounts for months while an understaffed compliance department reviews the file, you will likely choose the path of least resistance. We are witnessing the homogenization of wealth management, not by law, but by the sheer exhaustion caused by software friction. Ethically, we must ask, what happens to the concept of private property when the right to use that property is mediated by a proprietary algorithm that is legally protected from disclosure? We are trading the messy, human world of legal recourse for the clean, cold world of algorithmic finality. So, how does the modern investor, particularly those of us who prioritize long-term sustainability, navigate this? The answer is not to retreat from technology, but to master its friction points. We must shift our focus from mere asset allocation to custodial diversification. If all your wealth is behind the same software gate, the same bank, the same fintech app, the same jurisdictional code, you are not diversified, regardless of how many different stocks you own. You are exposed to a single point of failure, the algorithm. Navigating the future of financial freedom requires what I call technical sovereignty. This means maintaining at least a portion of your net worth in low-friction environments, assets that do not require a third-party API call to verify your right to spend. This might mean physical bullion, it might mean self-custody digital assets, or it might mean maintaining relationships with smaller, high-touch private banks that still value human oversight. We must stop viewing our bank balances as money and start viewing them as data entries that require a constant green light to remain useful. The goal is to ensure that when the software inevitably glitches, or the policy changes overnight, your life and your legacy do not stop moving. The liquidity trap of the 21st century is made of code, not lack of buyers. It is a silent, invisible barrier that tests our patience more than our portfolios. By understanding the shift from legal ownership to algorithmic permission, we can position ourselves not as victims of the black box, but as informed peers who know when to use the system and when to step outside of it. Stay analytical, stay calm, and above all, ensure that you, not the code, hold the keys to your horizon. I'm the horizon, and this is where we find clarity in the complexity.